Welcome back, everyone. We are back, episode 27. This episode, I really just wanted to kind of talk about the K-shaped economy and basically what is a K-shaped economy. So definitely tune into the video because this one's a very interesting video. So basically, the K-shaped economy, it's been spreading wider and wider since COVID. So you picture the letter K, the bracket going up, that is those who have assets and who are wealthy, and those are who are going down from the letter K. They're struggling, like making ends eat, they live check to check. It's kind of just hard right now, and it's just really hard to kind of stay afloat because of all the economic pressure that's been, hitting the everyday Americans since COVID started. So, but here or there, I'm definitely ready for this video. But first, as you guys know, we're going to start with the intro. So, with the stock markets, as you guys know, we've been getting some news about a peace deal between us and Iran for, I want to say, 90 days that's going to be from what I saw. So this is really going to be interesting. These next 90 days, are we going to see an actual peace treaty done? These things take time. There's a lot of negotiations going on, a lot of money involved. As you guys have already seen, from what it looks like, the U.S. already committed $300 billion to Iran for war damages on top of the United States lifting sanctions that we'd had placed on them. Not all of them, but we did lift quite a few sanctions, which opened up a couple $1 million for Iran. So yeah, it doesn't really sound like that's a peace deal that we won. Just based on how Iran really controlled the Strait of Hormuz, how they still control the Strait, and how they're getting 300 billion. Now, again, I'm no pro-Iran. I hope no one's really pro-Iran, but you just kind of got to go with the facts. And the facts tell you that we're paying a lot of money. We paid a lot of money during the war. We're paying a lot of money after the war. And that's a lot of money that could have went to, us everyday Americans in some way, shape, and form. So, but here or there, heading over to the stock market. So, stock market continued to climb. Stock market hit all-time highs. We had a pullback. I think it was last Friday, and then Monday looks like it wasn't really too pretty as well. Or Tuesday, my days are getting mixed up right now. But here or there, we did see the stock market rally. We did see Kevin Warsh have his first Fed meetings when they decided to hold rates steady. So, we have probably predicting rate hikes if you guys haven't really seen all the inflation that's coming out. So, with Kevin Warsh as the new Fed chair, it's going to be interesting to see what he does the next couple of months. I feel like the next couple of months are very, very important, even though the Iran, war, whatever you guys want to call it, it's a war to me. But even though that's essentially on hold, peace talks and peace deals, ongoing and signed, we're still not out of the clear when it comes to our economic data, right? So as we all know, tech has really, really carried the stock market for the past couple of years. It's been very tech heavy. I'm really carrying the stock market. So one thing we do know as well is the Feds are predicting a rate hike, because if we don't get inflation under control and inflation continues to climb, the Feds then don't have a choice but to hike the rates. And when they hike the rates, guess what happens? Those tech companies who borrow and borrow and borrow, because when you look at the valuations for them, they also include like the future projects and future valuation of it, right? Which I'll get into here in just a moment. So they're not counting just the revenue that it's brought in. They're also, predicting where the company can go based off its innovation and what they feel like that would be valued at during that time. So with that being said, if rates go up and it becomes more expensive for them to borrow, well, guess what? That starts to squeeze their earnings. And now when you have the quarterly earning report coming out and you're seeing that, hey, like, maybe NVIDIA, Microsoft, whatever, maybe somewhere in the report is showing that, it's not as strong right now as it typically is, which then will scare some investors off. And then that was when you start seeing red in tech, because when you hike the rates and the tech borrows, that borrowing starts to get more and more expensive. So, like I said in my prior videos, is that, we do see the stock market climb, but, at some point, if we keep seeing inflation, prices still keep going up, gas is down, but like it's still $4 national average. Like it's down from $5, but it's still $4 national average right now. So I mean, it's still up. It's still technically up from where it was. So did it come down? Of course, it was going to come down after the news, but it's still it's still up. So that's still eating at your pockets. So with the economic data getting worse, we still have, gas gas really high. Oil went down dramatically. Like oil took a nosedive from where it was at. It was over $100 a barrel, like over the over the weekend, and then once we opened this week, it dropped to like below $80 a barrel for oil. So, but that doesn't mean the gas prices are just going to shoot right back down right away, especially when the US is going through so much of oil. Like we were going through so much of our oil reserve that, if we kept going at this rate, like we were really going to be in trouble. If you really pay attention to those who are on YouTube, posting videos, watching, they were saying like, you watch out for oil, watch out for oil. We're eating through our reserves. Watch out for oil. Don't let us get through our reserves, because once we do that, there's no coming back. So we didn't really have a choice but say, we got to open up this straight. And you saw the stock market go up. But in my opinion, with all that being said, I believe that at some point, if the data continues to look ugly, that will start trickling into the stock market. Mortgage rates are back up, inflation's up, and again, gas is up. So like I keep saying, so at some point, like investors are going to look at that and be like, well, I'm going to have to park my money in somewhere a little bit safer right now, because we're seeing some negative data, and we're starting to see some red days. We're starting to see the stock market start to go down. But for you, that is a way, like if you're new to investing and you're seeing that dip, and let's just say stocks do pull back even 5%, because, right now you're seeing a lot of flash crashes. You're not seeing often a complete crash. You're seeing more just flash crashes than anything the past couple of years. So like it goes directly into a bear market, and then we hit damn near recession levels, and it's like, oh, well, hey, look, it goes right back up, and it hits all-time highs. So it's just been a crazy ride. Like the flash crashes, like that's why when you're starting to see, like, to me, when you're starting to see like these 5 to 10% dips in prices, I think that's a good time to get in. Again, if you have $1,000, don't throw the whole 1,000 in. Like I said, start maybe with 500, 250, 300, whatever you want to start with in that range, and then start averaging in that 1,000. So that way, if it keeps going down, you're still hitting on those lower and lower buys, because at some point, like if you're buying into the S&P, it's going to recover and it's going to hit all-time highs. So why not buy it while it's at a discount? So going back to what I was talking about when it comes to the evaluations and evaluation of companies. So put it this way. SpaceX just IPO'd for $1.7 to $2 trillion valuation. That is the highest valuation in stock market history for an IPO. You're seeing it really take off, but I'm on the sideline right now for SpaceX, because I learned my lesson with CoreWeave when they IPO'd. Now, I'm not saying CoreWeave is SpaceX. I'm not saying the CEO of CoreWeave is on the level of Elon, but you have to have the math start mathing. So I was asking Gemini, like, okay, well, what's NVIDIA's market valuation? And Gemini gave me 3 trillion. SpaceX is about 2 trillion after the stock really exploded after it launched its IPO. But check this out, like their annual revenue, NVIDIA's annual revenue is $215.9 billion. SpaceX annual revenue is $18.7 billion. The net income for NVIDIA was $120 billion profit, and then SpaceX actually had a loss at $4.9 billion. And then when I'm looking at this as well, so NVIDIA is basically trading at 14x, SpaceX is trading at 107x. So when I'm looking at this, that's why I don't want to get into the IPO, because what happens within the first 90 days of the IPO is very volatile, and then at that 90-day mark, you may have inside, those investors who got in before pre-IPO launch will start selling their shares and start taking some profit. But even with that being said, with the way the economy is right now, and just the way, like, I just need to get more, I need to see it more from SpaceX before I just throw everything in there. Like, if you're established and you want to go in, that's one thing, but it's going to pull back. It's going to pull back its IPO. And if I'm wrong, like, I'm wrong, but history really shows that when you have IPOs, especially when you're banking so much on Elon in the future of SpaceX for it to be already a $2 trillion market value. Like NVIDIA, how many times have you heard of NVIDIA, and when it comes to the stock market, and their valuation is only $1 trillion more, and they make way more than SpaceX. So I'm just kind of waiting, and then we'll see. There's always going to be a buying opportunity. It's just a matter of when it comes. There's always going to be a buying opportunity, just a matter of when. But I just feel like for me right now, it's just not something that I'm going to put into right now. So we'll see. We'll see how it goes. It's hard to bet against Elon when he's focused on being a CEO. It's hard to bet against him and his innovation. So another thing too. So groceries is up. So as you guys know, when you guys go to the market, you start to feel it in your pocket. And in April, by itself in 1 month, groceries went up 0.7%. That's the biggest single month increase in 4 years. So biggest single month increase in 4 years. So what does that really mean? Groceries are going up, gas is up, Americans are having to use their credit cards and things like Klarna and Afterpay just to get by. So we'll put it this way, right? So groceries are up 2.9 year to date, and you have your groceries are up 2.9, and you have to use your credit card that has maybe a 20-ish, 22, 30% interest rate, and that's the way that you're going to have to get by. But then you're check to check, so that money that you have for the money you needed for groceries, you put on the credit card, but you need groceries next week. So it's hard to pay off that credit card because you already used your credit card in that emergency case to get those groceries. And now you're paying an additional 20 whatever percent on the interest just to eat. So we're really seeing, this goes back into my point of like the economic data. Two things could be true at the same time. I keep saying it. The economic data could be looking bad while the stock market is going up. We've seen it be time and time again. But at some point, the economic data does impact the market, and that's when you start to see it come down. So again, if we're going at this rate, it's only a matter of time. Like, to me, Americans shouldn't have to use their credit cards at 20+% interest rate just to get by for the week, just because we just see this major run in grocery prices and just going out to eat in general. So I need to look more into this. I want to start doing some more research on why. I'm assuming it's because the international conflict that's been going on, but Bitcoin been nosediving recently. So yeah, I mean, to me, it's just one of those things. Like I said before, it's just something that you need to have in your portfolio as a small amount. Like, it shouldn't really be something that's a major. Like, if it's 10% of your portfolio, maybe you should just reallocate. Especially if you're starting out, maybe you should just kind of reduce that to like 5, maybe less than 5, in my opinion. Just because it's so volatile. Like, and when I'm investing, when I'm thinking about where I'm putting my hard-earned money, I want to build an egg nest that is secure. So what does that mean? I want to put into the S&P 500. I want to put into high quality stocks like the Mag 7, right? So it's just a matter on what price point are you going to buy them at? That's really all. Like, what price point are you going to buy them at? And once you get that price point, because it has like a pullback and you get in, it's going to go up, especially if it's something like a Google, Nvidia. Like, it's going to go back up because we rely so heavily on these companies. So, and one day we're going to have, I do think SpaceX can get there at one point. I just don't, again, the IPO and investing into it, that's just not my style. But then you have like Anthropic, SpaceX. So, you got, when I'm looking into these companies, I'm using like Anthropic's Claude. I'm like, wow, like they're really, like, to me, like, I used Claude for 2 days and I think it's the number one AI platform that I've used, in my personal opinion. But going back to Bitcoin, I'm really interested to see why it keeps falling, why it keeps dipping. I'm still holding on to the Bitcoin that I have, because why not? Why not? What do I have to lose by just holding it in there and just seeing what happens, even if it's in the next couple years? Like, I don't really see Bitcoin going under $40,000. So at some point, Bitcoin's going to bounce. It's just a matter of when. Like, at some point in time, Bitcoin's going to start getting some type of momentum. It always happens. It just takes a very long time. But then you'll see it hit new all-time highs. So, and Bitcoin doesn't really, when I was looking at it, isn't compound the same way stocks do. So when I'm thinking about it, like, yeah, I may have to look into my tax bill, but do I start treating Bitcoin as like, okay, it hit the all-time high. How much do I take, put to the side, wait for the dip, put in rinse and repeat? Like, how, like, when does that start to become, a play? So maybe what I'm gonna do is use Claude and have it map me out a plan. Like, hey, like, this is my thought process with Bitcoin. That way it's kind of rinse and repeat, since it doesn't gain the traditional power of compounding interest like a normal stock does. Like, where can I buy? When I sell at the all-time high, where do I park my money? What do I invest in? So when Bitcoin does pull back again, I'll be ready to deploy that money back into the lower price, let it build back up, and then kind of build your building blocks from there. And then you start to rinse and repeat. And I think that may be the way to make sure you're always ahead of the game when it comes to buying in at the Bitcoin, and your average cost of Bitcoin that you're putting in, where Bitcoin's valued at, isn't nowhere near the all-time high that it could hit. So to me, that might just have to be the play. I just got to look more into it. So anyway, we're going to go ahead and get started with the K-shaped economy. So yeah, tune in. All right. So what is the K-shaped economy? So like I said, basically picture the letter K. The top of the K is high earners, the lower the K is lower earners. Again, since COVID, we've really seen, our economy kind of start to divide. So you really see those who own assets and who are the high earners get more and more comfortable as their assets continue to grow, as you're still seeing the most, a lot of common Americans who are still trying to recover from the woes of COVID. We're still, in that inflation wave on top of, wage growth. Right now, inflation is beating wage growth. So even if you do get a raise, you're still not really getting a raise because everything else is still getting more expensive than what your raise is at. So what does that all mean? Is that now the money that, that had the purchasing power last year with your raise is basically what you still have this year, if not less, because your raise did not match or was above inflation. And people don't really think about that when they go for a raise. So you always have to keep that in mind. Like, if you're getting a raise and it's not really above inflation annually, you're technically losing money. So there's a well-known issue about the wealth gap in America. As we had, jobs being lost, we didn't have, people get jobs in very, important spaces. I think the job creation, yeah, you're losing a lot, but you are creating crazy type of jobs with AI, crazy kind of like AI engineering type of jobs. So, but when you're losing these jobs and you're laying these people off in this type of economy, it does have severe impact to their day to day. And it's very, very hard to catch up. Because think about it like this, right? You just out of nowhere get laid off. Company just lays you off. Think about the economic hardship that the U.S. has been through since COVID as a country. Imagine your only source of income lays you off. You still got your bills to pay, still got your debt to pay, still got to feed your family. Yeah, then money's going to start getting real tight, and most Americans don't have an emergency savings funds set aside, so when they do get laid off, they can at least have some type of cushion until they find a new job. And then that just rolls you more into debt. Like, it's a trap. It's a trap. It's honestly just, they know what they're doing. They know how to do it. They know how to play the game. They know how to manipulate people's feelings. They know how to keep the common people away from generally investing in stuff like that. They control a lot of the money that walks into the stock market. So they can kind of manipulate as they please, especially when you hit those really, really, really high earners who invest. So as you're losing these jobs and you're getting all this economic hardship, wage growth is down, you got housing up, groceries on the rise, inflation's, like I mentioned, the current impact of AI laying people off, but also, still creating jobs. But the everyday American is feeling it. And when I'm looking at all these, clips, these reels, these videos, these episodes, whether it's on YouTube or Facebook Reels, whatever, like, I'm seeing a lot of people who talk about the economy go back into the stock market and talk about how high the stock market is. But again, like, the stock market isn't the economy. Like, if we're being honest, a common person is not invested into the stock market, or they're not seriously invested into the stock market. So by them saying the stock market, it's because of this, that's the reality they live in. But the common person that you see walking into the grocery store, that you're walking next by, like, they may not have access. Everyone has access to the stock market, but they may not invest. They may not have a 401k that goes into the stock market. They may just trying to be getting by at using their credit card at the grocery store. So, like, when people say that, it's like, no, you can't compare that, because again, not every normal day Americans invested into the stock market because of the rhetoric that they put out and the fear that they put out about the stock market. Now, you do need to do your research. You do need to be educated about it. And, the more I continue to grow, the more I continue to learn, the better I feel like I am at maneuvering through the stock market. Like, I don't day trade and stuff like that. Like, no. But when it comes to like the returns I've been getting, it's not vastly over the S&P, but I did beat the S&P by like 2% last year. And right now I'm kind of neck and neck with it. So I must be doing something right. Just about a way. So why fix something that technically isn't broken right now? Like, why do that? So, I just stick into my plan. But again, it's just most people aren't invested into the markets, and they're just trying to get by. And this is where you have the really uber rich buying all these flash crashes, all these flash dips. Like, they're buying into these at, thousands of dollars, and then they know the stock market manipulation is going to happen, and then once it happens, they get very rich. They start to grow their wealth, while again, we're people at the grocery store paying with credit cards, going more into debt. So that's why they're talking about the wealth gap is getting wider and wider and wider in the form of the letter K. So, like, again, you hear people say on TV all the time, this is such a great economy. We're in the greatest American economy all the time. Stock market's at an all-time high. But again, sit back and ask yourself, do I really feel like I have more money in my pocket? Do I really feel like I'm not spending more when I go somewhere? Like, is that really what I'm doing right now? And the answer is, you are spending more. You are spending more. It's two types of economy, and that's why we talk about the K-shape. The rich and, the rich and the poor. Like, I hate to say it, but the rich and the poor. That's really what it is. You got people who are very much at the top, and you got people continue to going down, down, down at the bottom. And yeah, it is bad for America. Like, it is bad because now you're having, again, this 1% of group own a vast majority of wealth in America. And again, like I'm saying, like, they have so much power to manipulate the stock market if they wanted to. Like, it's so crazy that the 1% owns 31% of Americans' wealth. The 1% owns 31% of Americans' wealth. This is the widest the gap has been since they started tracking this back in 1989. The 1% owns 31%. All right. That's a mind-boggling stat to me. They own over 1/3 of our whole country's wealth, the 1%. It's a crazy stat. The top 20 account for nearly 60% of all consumer spending in the U.S., and about 13% of all credit card accounts are delinquent by 90 days plus. I don't know how that's good for America. Like, those stats I just gave, I don't understand how that's good for America. It's good for them. It's good for those who are really rich, who are getting, who are basically there, who are uber wealthy. But then for the everyday American, they're left to suffer. Now, you can go back and forth and say, well, you have a choice to do this, you have a choice to do that. Sure, technically, yes, everyone has a choice to do more. Technically, I feel like it just all depends. Everyone has different situations. Like, that's the thing. Like, everyone has different situations, and everyone move a bit differently. So it's hard for you to set the same expectations for, other people. And that's just personally how I feel about it. All right. So as prices continue to rise, as I feel like my money is getting tighter and tighter and tighter, what are some things I can do to start feeling like I got money freed up? All right. So one, I would just say eat at home more, for sure. Going out is very expensive, especially nowadays. Don't DoorDash. Don't pay those extra fees, and do not pay that delivery fee either. And then you're going to have to tip what you should tip. Build a budget. So even if you have a budget, go over your budget. Just go over, see how much you're spending in groceries, because you probably haven't really updated that. Even if you track it, but you probably haven't updated it in quite some time. You'll be surprised. When I did it, I was actually surprised how much more I've been spending recently at the grocery store. So when you are updating your budget, go through the grocery store, and obviously gas, like, it's kind of, I'm paying almost double from what I was usually paying for in gas before the war. So pay yourself first, set money aside, find a way to grow some money. Even if it's $5 today can become a lot over time. So you got to find a way to start having your money generate more than you got to find a way to beat inflation. You got to find a way for your money to generate more than that 4%. You got to find a way to make it generate 5%, more than 5%, because you really want to try to stay ahead of the inflation. And really, one thing I learned, the only way you're doing that is if you're investing. When you go on vacations, I'm not going to sit here and tell people don't go enjoy their life. You should do it responsibly, and you should think about like what impact financially it can have for you, not even long term, but short term. Am I going to have enough to pay my bills? Like, you'd be surprised how people would be like, yeah, that'll become a tomorrow problem. No. So if possible, try to save again as much as you can. Even if you were able to save $100, $200, there's $100, $200 that you don't have to put on a credit card with a high interest rate. So don't forget to like, share, comment, subscribe. Thank you, everyone. Again, so we are heading into a K-shaped economy, but you can definitely be the one that changes your future by just getting started and understanding how to grow your money.